Political headwinds continue to stir the markets today as investors digest the battle between the Supreme Court and President Donald Trump. Our next guest says, make portfolios diversified again. Joining us now is Pierre Ouimet, head investment strategist at UBS Canada. It's good to have you join us, sir. Thank you so much.
Well, it's a pleasure, Lindsay. I'm glad to be here.
I like your slogan. What do you think about, everything we're seeing today? And does this ruling kind of reinforce your positive outlook on the markets, or are you thinking things could go in a different direction now?
It doesn't alter our perspective on things. It's it's finally out of the way. We have a decision by the Supreme Court, but it looks like the administration is fighting back. So I see that they want to impose a 10% global tariff or something like that. They have other recourses in terms of imposing tariffs as well. So, we're not out of the woods yet as far as the tariffs are concerned. So, but we're prepared to live with that. So, I think there are political issues that are ahead of us here that are probably going to mitigate in favor of not too much, not an aggressive stance on the tariff positions, and maybe the situation doesn't really deteriorate from here. But we're focusing on other fundamentals, and they're still quite good.
And I want to get to your make portfolios diversified again in a moment. But just first off of what you just said, do you feel like markets and investors are maybe becoming a little more immune to this uncertainty that we're so used to seeing now?
Oh, yeah. I mean, I'm surprised the market reaction is there's no reaction, really. It's to a large extent, it was probably expected. So a lot of people, thought that the Supreme Court would decide in that direction. So not a lot of surprise in the market. I'm surprised the bond market didn't react more because there's this whole notion of reimbursements as well, something close to $200 billion or so that would have to come out of the Treasury. But, listening to Besson today, he doesn't seem to be worried too much about that. He seems the revenues are going to keep on accruing to the Treasury. So it's, it's kind of a mixed bag really right now, but it doesn't really change the fundamentals that much.
Yeah, it is interesting to see the bond reaction for sure. Okay, let's talk about make portfolios diversified again. When it comes to diversifying your portfolio, where do you think investors should be doing that?
Well, it's... starting last year, we're kind of phasing out, we're not maybe phasing out, but reducing our exposure to U.S. assets, U.S. dollar-denominated assets, which has turned out to be a relatively wise decision, either repatriating to Canada or going in other jurisdictions like Europe or elsewhere. And, of course, the U.S. dollars come under pressure. So I think that continues, and the idea is to have your fingers in multiple pies and not necessarily focusing on one particular sector or one particular trend as well. So that's really what we're emphasizing is wide diversification. So we still like the tech sector, but we're a little bit more selective. We also like the resource sector, particularly gold, but even energy from a long-term perspective as well. Energy and metals, base metals. The whole AI theme continues to be relatively buoyant as well. I mean, we're kind of evolving very rapidly on the AI side, and as you noticed lately, there's been some weakness in software stocks. So that's kind of the third reiteration or the third wave of what's happening in AI, which is starting to develop.
Are there any sectors that you feel are undervalued right now? Like you went over the sectors that you like, but anything that you think is undervalued?
Well, energy is a sector definitely where there's a lot of good value, a lot of free cash flow. You look at free cash flow yields, for example, they're quite attractive. There's just not a lot of love for the sector right now, and that's showing up in the valuation. So that's an area that's relatively undervalued. Probably the mining sector and gold in particular. I mean, the valuations have come up. And the stocks have outperformed the commodity, no doubt, but the leverage on these price increases is extraordinary. Looking at the fourth quarter numbers of most of these mining companies, I mean, you look at the free cash flow and the EBITDA, and it's just soaring right now, and it's probably likely to continue. We think that gold still has the potential to go higher. In an uncertain world, it's a safe haven asset, and it's a little bit like the Swiss franc to a certain extent as well, has attracted a lot of capital because it's considered as a safe haven.
Mm-hmm. When we take a look at the TSX in particular, even over the last couple of days, it's been reaching new highs every day. It looks like it might do that again today. What do you make of that? I mean, you talked about, gold prices are up, which usually means the TSX goes a little higher, but what else could be some of the factors there?
Well, I think what we're seeing, broadly speaking, I mean, this is conceptual and it's kind of broad strokes, but clearly the return on capital is increasing, continues to increase. And we're seeing margins at record levels. And I, for one, last year was a bit worried, saying that maybe margins are peaking, but they're not. Margins continue to increase, and the expectation is that they will continue to increase. And what happens with AI? Once you start kicking in the productivity gains, does that mean that margins expand even more? And from that perspective, it probably means that if you look at what, the fight between labor and capital, it looks like capital is winning out, quite strongly. So return on capital will probably continue to increase. And the labor side is going to continue to struggle, particularly with the advent of AI. I mean, that's a little bit of an uncertain future as far as labor is concerned. And that means that earnings are going to be a lot stronger. And in an environment where rates are stable to potentially going down, that's the other thing. What's the Fed going to do? In this environment, we saw the GDP number out of the U.S. today. Of course, it was biased by the government shutdown in November. But the U.S. economy is, and labor in particular, is probably going to continue to slow, and that could probably push the Fed to reduce rates a little bit further, somewhere down the road. So that will help the markets as well. I mean, earnings and interest rates are what drive equity markets.
For sure. Okay, that is all the time we have. Pierre Ouimet, Head Investment Strategist at UBS Canada. Appreciate your time. Thanks for joining us.